In October 2025, JP Morgan CEO Jamie Dimon was asked about cracks showing up in the credit market. His answer was 6 words. When you see one cockroach, there are probably more. He was joking. He wasn't wrong. By April 2026, the data caught up to the joke. The Fitch private credit default rate, tracking over 500 middle market borrowers, hit 6%, the highest ever recorded since they started tracking it. And the part that should actually scare you isn't the 6%, it's what's hiding behind it. Here's where this starts. The 30-year US Treasury yield spiked to over 5% in early 2026, the highest level since 2007, before easing slightly to around 4.9 to 5% by June. The UK's 30-year hit its highest since 1998, Germany's highest since 2011. Japan's 30-year hit an all-time high. 4 of the largest bond markets on Earth all screaming the same thing at the same time. When that happens, it's not noise, it's a signal. And the signal is this: global investors are demanding more return before they'll lend money long-term because they're worried about inflation, about massive government debt, and about whether anyone can actually pay it back. Now, follow the money downstream, because this is where it gets interesting. There's a benchmark rate called SOFR, the overnight cost of borrowing for the entire US financial system. In early 2022, SOFR was basically zero. By mid-2023, after the Fed's hiking cycle, it was over 5%. And even after a year and a half of rate cuts, it's still sitting higher than pre-pandemic levels. Why does that matter to you? Because there's a $2 trillion corner of the financial system called private credit. Loans to companies too big for a small business loan and too small or complex for a public bond. And the majority of those loans are floating rate, meaning they're pegged directly to SOFR. When SOFR was near zero, the math worked fine. When SOFR jumped to 5%, the math broke. Here's a real example. In 2021, private equity firm Vista Equity bought a software company called Pluralsight for over $3 billion, funded partly with over $1 billion in private credit floating rate loans. For 3 years it worked. Then SOFR rose. By August 2024, Pluralsight couldn't make its interest payments. Lenders had to convert their debt to equity, inject $275 million in new money, and take 85% ownership of the company just to keep it alive. Pluralsight wasn't an isolated incident. It was the first cockroach. So how is the industry reporting record defaults while telling everyone things are fine? The answer is an accounting trick called PIK, payment in kind. Instead of the company paying interest in cash, the lender lets them skip the payment and just add the unpaid interest onto the loan balance. No missed payment shows up. No default gets triggered. The loan stays classified as performing, even though zero cash actually came in. And the lenders count that unpaid interest as income on their books. As of 2026, PIK usage has grown more than 72% since the end of 2021. More than half of current PIK loans were added after the original deal, meaning the borrower was already struggling when the PIK feature got bolted on. At one major fund, FSKKR, PIK income reached over 14.5% of total investment income, and loans where borrowers stopped paying entirely, called non-accrual loans, crossed 5%. It gets worse. A lot of private credit operates through business development companies or BDCs. These get a special tax break, zero corporate income tax, in exchange for distributing at least 90% of taxable income to investors. So when unpaid PIK interest gets counted as income, the fund is legally required to mail out a cash dividend on money it never actually collected. A company sliding toward insolvency shows up on the books as a healthy income-generating asset. The worse the borrower's finances get, the more income the fund reports, and the bigger the dividend check it has to send out. As of 2026, BDCs are running an average of 8% of their income through PIK, meaning 8 cents of every reported dollar is interest. Nobody actually paid in cash. And here's the consumer products sector specifically. Defaults there have crossed 11%, nearly double the broader market. Fitch recorded 11 default events in a single month earlier this year, almost double the 2025 monthly average of 5.9. More than 60% of those defaults involved a PIK conversion right before the company collapsed. The cockroaches are multiplying. Now here's why this matters for the next 2 years specifically. There's roughly $85 billion in BDC loan maturities coming due between 2026 and 2029. These are loans originated when rates were near zero. When they mature, they have to refinance at today's much higher rates. That's the maturity wall. And because most of these loans sit in a category called level 3 assets, meaning there's no public market price, no daily mark, just an internal model updated once a quarter. Nobody outside the fund really knows the true health of these loans until they're forced to refinance and the math finally hits reality. MSCI already found that more than 10% of private credit loans were marked down by at least 50 cents on the dollar. That's half the value, gone. And most investors have no idea. This is exactly why finance, Twitter, and YouTube are calling this the new shadow banking crisis and drawing comparisons to 2008 subprime. The comparison isn't perfect, but the structural similarity is real. Opaque pricing, hidden leverage, interconnected exposure across banks, insurers, and pension funds that hold pieces of this $2 trillion market without fully realizing how much risk they're carrying. The Financial Stability Board has already issued warnings about it. So what do you actually do with this if you're a regular investor? 3 things. First, if you're invested in any BDC or private credit fund through your 401k or brokerage, check what percentage of their income comes from PIK. If it's climbing toward double digits, that's not a healthy yield. That's a fund mailing you a check with money it doesn't have. Second, be skeptical of any investment advertising suspiciously high, stable yields right now. In an environment where SOFR sat above 5% for 2 years, a fund claiming smooth double-digit returns with no volatility deserves real scrutiny, not blind trust. Third, pay attention to that 2026 to 2029 maturity wall. As $85 billion in loans come up for refinancing at today's rates over the next 3 years, watch for rising default headlines. They will be the visible tip of a much larger iceberg that's been hiding in level 3 valuations for years. Jamie Dimon's joke wasn't really a joke. When you see one cockroach in a system that's allowed to hide its losses through accounting choices instead of cash flow, there are always more behind the wall. The math doesn't disappear just because nobody marked it down yet. It just waits. Next week, I'm breaking down exactly how to check if your own retirement accounts have any private credit exposure hiding inside them. Subscribe so you don't miss it. And if this opened your eyes to something you didn't know was sitting inside your investments, share it with one person who needs to see this before the maturity wall hits.